As summer begins in earnest, the slowdown in the markets begins as well. Summer tends to be a little sleepier for the markets, unless, of course, there are as many events going on as there are this year. The tug-of-war that I keep referring to between the Fed's need to cut interest rates to stimulate the economy and, in the process, make real estate more affordable to the purchaser is being negatively counterbalanced by inflation numbers, employment numbers, and wage numbers that are showing a still too resilient consumer. Based on the action of investors, they are clearly on the defensive as they have been active at pulling funds from equities. This past weekend, Barron's showed a picture of Fed Chairman Jerome Powell on the cover with the quote, "Why he won't cut rates this year." The overriding issue that seems to be swaying the normal way of measuring this tug-of-war is unquestionably the $6 trillion sitting in cash, earning a no-risk 5%. This not only is continuing to provide liquidity, but an unquenching purchasing power by the consumer. This brings into question who is in control of this massive cash balance. And this seems to be obvious if we look at the delinquency in credit card payments. The lower and middle income consumer often have to depend upon credit cards to meet shortfalls, where the higher income brackets are diligent to pay their monthly credit card bills to avoid the exorbitant interest rate charges. At a deeper level, it is important to not just look at the consumer, but more importantly, the broad economy at the GDP, or gross domestic product level. The real root of GDP growth is the real story on Q1 GDP. Government spending accounted for 34.4% of all the spending. Over 1/3 was from the government spending, well beyond any tax dollars that the government can collect. If you remove the spending for the Ukraine and Israel wars, GDP was negative. Government spending is propping up the GDP growth. Oil has decreased in price, likely because economics are poor enough around the world to reduce demand as seen here. That helps, but it does not solve the problem for other critical areas. I bring up oil as it is still the backbone of measurement for an industrial economy. The point: the GDP issues show the CPI, PPI, and PCE numbers are the tail wagging the dog. They are the symptom of the problem, and the Fed is focusing on the wrong issues. Growth was the softest since Q2 2022 and much weaker than the 4.1% average annualized rate in the second half of 2023. A significant drag in Q1 came from inventory investment, down 0.45 PPT, and net exports, down 0.89 PPT, both revised down from the original estimate. But final sales to domestic purchasers, which exclude inventories and net exports, rose at a 2.5% annualized rate, only slightly below the advance estimate and the average rate of 2.8% since 1980. This illustrates a final perspective on the progression of GDP. Please note the massive volatility due to the COVID period and how it is now largely normalized. The Fed, however, won't break things in an election year. Powell wants to avoid that humiliation, so no breaking things, and will likely cut pre-election. The dip in the PCE gives him some sort of moral authority to cut the rates, and thus we should see the PCE grow at around the same rate or slightly lower. If things really get out of hand on the election front, we could see PCE go negative. This leads us to additional measures of weak economic data. Income and spending were considered palatable, but the bottom line is not. Real spending fell 0.1%, when nominal growth was said to be 0.2%. Pending home sales, April sales were down 7.7% versus a drop of 3.6% in March. Record lows. Bank deposits. The Fed reported large banks gained $2 billion in deposits for the week. If you look at the unadjusted numbers, seasonal of course, the actual numbers, large banks lost $98 billion in deposits. Once again, reality differs from the made-up world of government and not-so-government entities such as the Federal Reserve. I want to give an update on the amount of money that is still sloshing around out there. I referenced this in the beginning of this comment, but wanted to show an updated illustration of the number. It reflects the amount still in savings post the pandemic. This is what I believe, on top of U.S. government spending, is swaying consumption and accurate economic growth measurements. All these points I've just made, I believe, point to just the opposite of what we were presented with by Barron's last weekend. As evidenced by the ISM numbers on Monday and the job openings yesterday, the Fed might have to provide liquidity in the form of lower interest rates in short order should economic cracks form. See what the 10-year Treasury market is saying as of yesterday, midday. The strange thing is that if interest rates were to fall, this could be the catalyst for the rally that is seasonally and statistically expected. I have brought up the election cycle numbers and the seasonality numbers before, but here is an update. For the S&P 500, June through August has been the strongest three-month stretch of a first-term election year since 1929. This is a fairly strong statistic, as it has taken into account many different economic, global, and political environments. I will close with a measure of the performance of the 11 sectors of the S&P 500 from the beginning of the year through May month end. Note that only 3 of the 11 have done better than the entire S&P. This shows ample room for a broadening of the market index's performance into the election period. We will continue to follow the economic indicators as well as the earnings action of individual companies and sectors. If we notice a change afoot, we will make changes to the portfolios. As for now, we are prepared to digest the ample amount of economic data being presented this week. As always, please contact us with any questions you may have.